Hey, good afternoon, everybody. Thanks for joining our panel. We're going to talk about leverage use by closed-end funds. My name is Fayvilevich. I head up the funds team in the US for Fitch Ratings. Our group assigns ratings to debt and preferred shares issued by closed-end funds. We also do some research around the space, and we've been doing this panel for quite a few years, and we have a great panel this year, and I'll let the panelists introduce themselves.
Thanks, Greg. I'm Bill Meyers. I work at Nuveen. I've worked there, I guess, for a while, about 27 years. I'm responsible for working on the origination and issuance of new closed-end funds. In my role, I've also worked on structuring and designing different forms of leverage.
My name is John Roglieri. I work for BNP Paribas. I run our structuring team there, which is responsible for lending to a multitude of closed-end funds in various different products to employ leverage.
My name is Adam Joseph. I'm at Wells Fargo. I head what we call our capital strategies group within our municipal products area. And among other things, we structure and purchase leverage products from, among other things, funds run by Bill's company.
We all report to Bill somehow.
Exactly, right? All roads lead to Bill.
We'll talk afterward.
Great. So let's kick it off. So we'll start with a little bit of an overview of leverage use in closed-end funds. So you may know closed-end funds typically use leverage to boost income to investors. And there are a number of aspects that limit the use of leverage. Primarily, the 1940 Act that regulates the leverage ratios that funds can have. And then to the extent, the fund documentation also limits leverage use. It can be at higher or lower ratios than allowed under the 40 Act. And of course, to the extent leverage, such as debt or preferred, is rated, there'll be rating agency limitations or requirements around the testing and the asset coverage, and we'll get to some of that a little bit later. What you see on the slide here, we just took, this is all based on public financials and reporting by closed-end funds. So essentially we took the leverage ratios that the funds report, or we calculate them for taxable funds and municipal funds, and basically each dot that you see on the chart is leverage ratio of one fund. So you can essentially see how they're bunched up. Taxable funds kind of around the 30% leverage ratio, so kind of from mid-20s to mid-30s percent, and municipal closed-end funds typically a bit higher in the high 30s and sometimes the low 40s. And they'll have kind of bands that they manage these ratios around to keep in line with the risk management practices. And yeah, so maybe we'll start with Bill. If you can give kind of a quick overview of how do you manage the leverage at Nuveen funds overall, and then we'll get to taxable muni funds specifically later.
Sure. Within these two areas of the charts, Nuveen is pretty well represented within each. What I can say is that Nuveen's leverage ratios for the taxable funds, we generally have two tranches that we target within the leverage. We have preferred and loan funds target ratios in the upper 30s, so mid to upper 30s. And then for our other taxable products, we're in the upper 20% range. What I can assure you, if you look closely enough at this chart, we do not have that top dot within the chart. So I think there was a CLO or something that snuck on here, but we generally target leverage ratios that are in the 30% range for the taxables. On the muni side, is indicated by the chart, they're a bit higher, and the muni funds are generally sourced through preferred shares, which, as Greg noted, have higher leverage allowances under the 40 Act. So if issuing preferred shares, you can technically go up to about 50% leverage on the taxable, tax-exempt side, or the preferred share side. So the munis target leverage ratios for Nuveen in the upper 30% range. Nuveen, unlike maybe some other sponsors, we have certain target leverage ratios that we look to manage around, and we tend to not tactically leverage above or below. We just have a target that we seek to comply with over time.
And thanks, Bill. And by the way, that is actually a U.S. closed-end fund. We won't disclose here who it is, but the chart shows that you have the limitations imposed by the 40 Act, right? So how can a fund go above that limit, and quite significantly so? So there are certain securities or certain forms of leverage that funds can use that allow them to go around that specific requirement of the 40 Act. So for example, derivatives are not counted under those requirements, and reverse repos aren't counted, and TOBs for municipal closed-end funds. Maybe turn to Adam. Adam, so you buy some of the preferred shares issued by some of these closed-end funds. Can you give us a bit of an overview of how you look at them?
Sure. We look at them as a way to get exposure to the muni market on a heavily collateralized basis. So, as Bill was saying, a typical leverage ratio in a muni fund might be between, let's say, 35 to 40%. On top of the 40 Act leverage limitations, we also build in some other contractual limits that take into account, things like TOB leverage or derivative leverage, just to make sure that we really have control over all the leverage. And so in a typical fund, you might have a $1 billion market value of assets and total leverage of about, again, let's say 40%, which we view as a very good risk proposition, particularly relative to some other ways that we fund other investors in munis. In terms of trends that we're seeing in the market, I would say starting about when we first started buying preferred from Nuveen funds and from other funds, the typical transaction would have a tenor of maybe 3 to 5 years, and would be, let's say, based on the CIFMA index plus 100 to 125 basis points on a tax-exempt basis, which again, for a AAA asset, thanks to Greg, is a very attractive investment. Over time, I would say, starting really in earnest about 18 months ago, the funds themselves have come back to us and said, hey, in exchange for shortening up the tenor from, let's say, 3 to 5 years to maybe a year, can we give them a break on the spread? In other words, take it from 100 down to 70, 75, 80 basis points. And I think that the motivation being, as the yield curve has flattened, the funds are getting squeezed a little bit, and they're looking to economize on spread. And we've generally been willing to accommodate that. I would say that the average life of our portfolio of preferred probably fell from, probably 3 years to now closer to, 1 and change, in exchange for less spread. So it kind of benefits both of us in the sense that there's a bit less risk for both parties. I would say the other major trend that we've seen, which has been driven by tax reform, is one of the things that tax reform has done is cut down on the overall supply of bonds in the muni market. And yet you have a lot of kind of captive investors who only want tax-exempt income. So what it's done is taken a lot of long-term bond funds and SMAs who would normally be buying long-term bonds, new issue bonds, and forced them into the very short end of the market, thereby depressing the short-term tax-exempt indices against which these funds are structured. And so the CIFMA is the main index. Typically, you would think it would be trading at around 70 to 75% of LIBOR. It's currently resetting at like 55% of LIBOR. So you can imagine there's a lot of yield give up for the bank that's owning that paper. And so what we've been able to do, again, with most of our closed-end fund companies, is to agree to convert a good chunk of our assets from a CIFMA-based index to, let's say, a 70 or 75% of LIBOR-based index, just to give us a little bit more of a hedge against technicals in the market. So we're probably at about 50-50 CIFMA LIBOR. So I'd say those are, the two of the big trends. A third one maybe we'll come back to later is the TOB funding. We can kind of come back to that one.
Okay. Adam, maybe just to follow up, in terms of kind of the way you look at it, what's kind of most important for you? Is it the current portfolio? Is it kind of high grade or high yield? Or is it the manager and quality and kind of the relationship you have, or the covenants? What are some things you look at?
Well, we do, I would say big picture, we are looking at it as a little bit of a hybrid proposition. We certainly like the investment as it stands on its own two legs from a risk-reward proposition. But there is also definitely a relationship aspect to it where we have huge trading relationships with Nuveen, BlackRock, Invesco, all the major fund families. And we do view this as having a relationship lending component to it that drives other business that we do, whether it's secondary market trading or underwriting of new funds. It's definitely kind of in that relationship context. I would say in terms of how we look at things from a credit perspective, we're definitely looking at the sort of mix of investment grade and non-investment grade in a typical fund. They tend to go anywhere from 50-50 would be a fairly aggressive portfolio. A more normal one might be 80-20, 70-30 in terms of investment grade, non-investment grade. And then we also look very carefully at the liquidity characteristics of the bond. Obviously, we're always looking for what kind of maneuverability the portfolio manager would have in a crisis to delever. So.
Yeah, it's somewhat easy to look at it bluntly and saying you have $1 billion of assets and $380 million of preferred, so the asset coverage is very strong. But again, it goes a step further. It looks at the nature of the assets, the rating of the assets, the liquidity, the diversification of the assets. So it's a much more nuanced view that the counterparts do when they evaluate leverage that they look to buy.
Yeah.
And John, you also went to closed-end funds on taxable side. Maybe we'll cover kind of specifics over the margin loans in a bit, but maybe high level, can you give us an overview? Kind of similarly, do you look at the type of portfolio, the manager? What are the parameters?
Yeah, we've been in this market since 2008. So I think when you saw the auction rate preferred market stall, we looked at the asset-based lending aspects of closed-end fund leverage and really drew parallels to a prime brokerage framework. So this is very similar to what Adam was highlighting in terms of asset level analysis, in terms of haircuts, based on credit quality, based on perceived liquidity under stress, and other attributes. So we do look at it, very much that way. We take a great deal of comfort in the fact that the 40 Act does dictate such high degrees of coverage. But I think that we've been very successful in not just looking at that as the defining factor, because I think that really getting into what the assets are and being able to mark them to market daily and having a good handle on what their attributes are is the framework of our analysis.
Okay. Right, quickly, just on ratings. So this is a snapshot of the rated closed-end funds that Fitch rates. Main takeaways from here, you can see most of the exposure is really high grade. I mean, a lot of AAA and AA exposure, kind of much less on the single A side. And I think that reflects some of the comments that John and Adam made, where historically there's been, from a creditor perspective, this has been a very strong performing asset class. I mean, as far as I'm aware, there's never been a default on debt or preferred share instrument by a closed-end fund, and certainly as long as Fitch has rated them, which is probably a 15, 20-year period. And so high level, the way we look at them, I think it's in a way similar to the way the other guys do. So we look at each of the assets in the portfolio, whether it's equities or loans or debt. We'll assess the liquidity of each one. We'll assign a haircut based on that. And essentially, you get to a discounted or a haircut value of the portfolio that which we think would be a reasonable estimate for at what level you are able to actually liquidate the securities if you need to delever. And then you compare that to the level of issued debt or preferred shares, and that's how you get to your ratings. And obviously, to get to a higher rating, we assign higher haircuts. For a lower rating, lower haircuts. Essentially, that's how it works. The structure has actually worked very well through a number of crises. I mean, these funds have been through the 2000 downturn, 2008, and then the energy downturn, 2015, 2016, where we've seen MLP funds, under quite a lot of stress, and they've done what they were supposed to per their documentation and the structure. They delevered, and we can get into that a little bit more detail later, but essentially it's been proven to work. So I think institutionally for us is kind of a lot of support for this kind of structure. All right. So now getting into a bit of the specifics. So what we're showing here is the profile of leverage for taxable closed-end funds, and goes back to the beginning of '08 and then through the end of 2018, so about 10 years. So one of the clear things you see from the beginning, initially these funds had quite a bit of auction rate securities. That's gone away for a while. And then the remaining leverage now is primarily bank financing, and there's a good portion of preferred, and there's a number of channels to distribute the preferred shares. So it's been privately placed with insurance investors. There's some retail preferred, and of course some bank preferred on more on the muni side. In terms of the trends, so you see there's a dip there from 2014 or so. That's when MLP funds were were performing really well. They've added leverage, and then after the decline in the energy markets, they delevered, as I mentioned. Since then, there's been a bit of an increase in leverage, and then over the last year or so, it's been fairly flat. Increases are primarily in a bank channel, so repo and either margin loans or credit facilities. We've seen some decrease in the auction rates securities. Another trend that's probably worth mentioning that we've observed, at least from our perspective, we've seen funds that have maybe historically over the last couple of years have run with leverage levels that kind of are close to the limitations of the 40 Act. So for example, if they had a credit facility and they were running at 31 or 32% effective leverage, that's very close to the regulatory limit of 33%. And we've seen a number of transactions where fund managers have refinanced a portion of the bank facility with preferred shares, and preferred shares are subject to a higher regulatory limit at 50%. So if you have a balance of more flexible bank facilities and some preferreds that's a little bit longer term, there are other motivations for the transaction, but effectively it gives you a bit more of a cushion to manage your leverage ratio and won't force you to delever if markets decline. And John, maybe just back to you. Could you describe in a bit more detail, how the margin loan program works and the reverse repos that you guys do?
It's interesting just to follow up on one of your comments there in terms of the balancing. I think we have seen, and just picking up on trends, the balancing between term issuance and the use of a margin loan, right? A margin loan provides a very high degree of flexibility. And so a difference between a margin loan and a repo is that a repo is largely a by appointment financing arrangement where each asset, has its own, haircut and schedule and its own booking into a repo system, which is a little bit more operationally cumbersome than having a broad-based facility in a margin loan. So a margin loan really provides, generally for our clients, we typically write these at 179-day evergreens, so they're rolling. So customers are comfortable that they have financing, for a set period of time, and every day you wake up and this resets to another 179 days. And those facilities are designed to be portfolio facilities. So there are collateral requirements that prescribe a AA rated asset has a specific haircut. So portfolio managers have a higher degree of visibility in terms of what fits neatly into that facility as they want to increase or decrease leverage. Again, that really comes down to somewhat of an ease of execution. One of the requirements for the 40 Act funds is that their assets be custodied at a U.S. custodial bank. So we have, we operate in a platform where there's a segregated pool of collateral that, stands as margin for the loan. And we have visibility into that. But portfolio managers can put collateral in there and know on a, prescribed manner what their ultimate leverage is going to be based on the portfolio characteristics we agree upon, at inception. The repo side, like I said, is a little bit more cumbersome. It is more asset specific, and it is more less of a facility and more of a kind of point to point financing. But we have seen an uptick in that as well. And I think you made reference, Greg, to repos also in a way can sit outside of the 300% asset coverage test, which can allow for some enhanced leverage.
And Bill, from portfolio management perspective, can you give us your side of how you look at the different types of leverage? How do you decide which ones to use? And
Sure. I love this chart because it shows the changing nature of leverage and what it's been through this and actually the next chart. But, the far left bar, it shows ARBs and the dominance of ARBs. And in this chart and the next one indicate what happened in 2008 and really the behavior of the underlying asset classes on taxable funds and on munis. But you see the drop, the sharp drop from 2008 to 2009. And what happened is there was a lot of payment down of auction rate preferreds because there were asset coverage breaches on the taxable side. So for closed-end funds that are designed and created for payment of common stock dividends to their shareholders, if you want to keep paying common dividends, you need to keep the leverage on the right side of the 40X. So you see a pretty big delevering early on in 2008 to 2009, so funds could continue paying dividends. But what we've seen is really the retirement of the auction rates in large part, and as you move further to the right on the chart, just a variety of more flexible forms of leverage. The ARPs were quite inflexible, where you had certain notification periods to redeem the leverage. You needed to call it in and work with the SEC to put out certain notices to redeem shares. With margin facilities, for example, you can just pay it down with very minimal notice, and you can move the leverage pretty rapidly. So I think on this slide and the next one, it's really just a variety of forms of leverage that are much more flexible and compatible with managing the product in the new market.
And maybe just to piggyback on Bill's point, the funds will have different strategies, and some will use kind of only bank facilities plus repos, or you probably don't see as much just preferred. But for the ones that use preferreds as a complement to bank facilities or repos, typically the way they do it is they'll look at the bank facility as kind of the more flexible portion that they can move up and down, as market conditions change, and the preferred portion, or even maybe a bank term loan, as termed out, and you don't have to worry about that source of financing maybe for a couple of years. And let's say during the downturn in the energy market, we've seen MLP funds kind of really use that kind of full capital structure. So when they have to delever, they'll take down the bank facility first, as that was more flexible. It's easy to put that up or down every day, and then the notes and the preferreds kind of later on as market values continued declining. All right, so moving on to the municipal side. More stable in terms of the total amount of leverage you can see over the years, but maybe a bit more dislocation in terms of the types of leverage that Bill was referring to. Again, I'll let Bill talk about that a bit more. But we've seen kind of new products come to market. You see every couple of years there's a new product, usually the brainchild of Bill and his associates. And kind of the latest we've seen is the MFPs, the Municipal Fund Preferred. And essentially the MFPs are a bit of a hybrid. I mean, typically they'll have longer maturity, but then they can take the form of almost one of the other types of leverage, so either VMTP or VRDP. And again, I'll let Bill cover that a bit more. But we've seen those type of preferred shares refinance some of the ones that were launched a couple of years earlier, as everybody is optimizing, the form of these securities. And we continue to see the auction rate securities that remain, go down. We've seen a bit more activity in 2018 with quite a few funds refinancing the auction rate securities that they had. And again, I'll talk about that a little bit later about in terms of cost. But maybe turn to Adam first. Adam, can you give us kind of high-level overview of some of the differences between the different forms of leverage in the muni space?
Sure. I mean, I would say the broad history would be, auction rate preferred was the go-to product for a long time, and then in 2008, 2009, the auction rates all failed. I mean, it had nothing to do with the quality of the underlying funds. Municipal auction rate Securities, that market failed. Auction rate preferred failed. It was really a problem with the mechanism more than the underlying quality. And as many of you are probably aware, there were settlements with the various attorney generals across the United States that resulted in the dealers of those securities purchasing them back largely from retail investors who had bought them thinking that they were always convertible to cash, and the dealers had to buy them back at par. And in many cases, we're marking them down simultaneously to 70 or 80 cents on the dollar. And obviously that caused a tremendous amount of strain on the dealers. And also, created a need to find some more viable structure to finance these funds, because clearly it was bad enough that market had failed, but clearly no one was ever going to buy any more of it. So Nuveen was really a pioneer in terms of coming up with the first alternative to auction rate preferred, which was called variable rate demand preferred, or VRDP, which was just basically a bank letter of credit. I'm speaking a little bit loosely here. A bank letter of credit backed 7-day puttable security that was really designed to be purchased by money market funds. And it was very similar to a municipal bond type product, had to be tweaked a little bit for certain tax reasons. And basically, there was a wave of refinancings of auction rate preferred with variable rate demand preferred, and that was really the first kind of wave of refinancings. After that, starting like in 2011 maybe, Bill and I and a couple lawyers actually worked on the first variable muni term preferred deal, which was basically the same tax structure, but rather than a bank providing a letter of credit to support floaters sold to money funds, the bank just bought the paper for its own account. And that was what I was saying was kind of like the 3 to 5 year term, formulaic coupon, CIFMA plus 100, something like that. And that was kind of the second wave of product that came out. I would say up until recently, VMTP was probably the dominant product, but I think but because it is a bank-owned product and because it's tax exempt, it took a little bit of a hit from tax reform, which just makes holding tax exempt assets a little bit less attractive for banks because the corporate tax rate. All of us in the room, from a personal perspective, got a small tax cut, but corporations got a massive tax cut, which is actually bad for us as tax exempt investors. So as the demand for bank-owned product waned a little bit, the next wave of products is, I think Greg was referring to, what I would call kind of a bit of a hybrid product, or sometimes in the muni market we might call it a VRO, a variable rate obligation, where you go out with a long-term maturity, no bank enhancement at all. You set a rate every 7 days or 30 days or so, and as long as investors want to hold it at that rate, they do. If they don't want to hold it anymore, then basically the rate flexes out, the put period flexes out to 30 days or 60 days or 365 days. It flexes out to a longer period at a higher rate, giving the fund some time to figure out how to restructure it. And I would think that as Bill and other folks in his seat look at that product, they're kind of balancing out probably the lower expected cost of that product over short periods of time against the fact that it's just not as committed funding as going to a bank and selling VMTP for a year or 2 or 3 years. But it's certainly part of the mix. It makes sense. I would say the only other thing that I wanted to mention from before was again, a lot of the assets that we still hold, the variable muni term preferred assets that we hold, which are CIFMA based, they're a tricky asset because CIFMA is bouncing all over the place and has had a tendency over the last year or two to be very rich and very unattractive to us as an investor. There have been various attempts over the years to fund those positions in what are called tender option bond programs, which are just single asset securitizations that a bank can use to access CIFMA funding. The point being, we don't really care where SIFMA is if we're both earning it and paying it at the same time. It allows us to just focus on clipping the spread. There have been some idiosyncratic issues about auction rate. About tax-exempt preferred that have made it somewhat difficult to top fund. There are kind of some inside baseball tax issues, but I think the market is taking another run at it, and there's a couple of structures out there that I think are going to get tested the next few months. Different forms of credit enhancement, and also possibly going without credit enhancement to longer-term investors. So again, I think that could be another thing that could lead banks to be able to charge lower spreads against SIFMA and maybe take a little bit of air out of some of these other products. But again, it's always a dynamic mix. I would think, as you know, from the perspective of a fund manager or of a fund treasurer, if you will, you want some mix, and you want to have exposure to different investors and diversify your investor base and diversify your structures.
Yeah, I think this is being recorded, so I think I heard you mentioning a lower spread to SIFMA in the future. So anyway, maybe I'll just comment briefly about the nature of preferred. I think there's been a whole lot of changes in the market over the last several years, going back to 2008. We've had just the rush to refinance auction rates to try to find more stable, cost-effective forms of leverage for the funds. At Nuveen, we really like leverage. We think it adds a ton of value to the closed-end product, and the typically persistent slope in the yield curve. We think that's something that makes a lot of sense for the funds to exploit. So with that, we need to stay ahead of these changes in the market, the regulatory changes, the bank changes, changes in money market funds and demands. We talked a little bit about VRDP. That was a product designed and sold exclusively to tax-exempt money market funds. When we created it, there was about $500 billion in tax-exempt money fund assets. I think recently it's around $140 billion. So it's a much smaller market. So we've needed to stay ahead of the demand and try to find different sources where we can sell the leverage to that are cost effective for the funds.
Thanks, Bill. That's a good segue. Our next slide, it just shows the actual issuance in muni space. You can see there the MFPs had a big year in 2018. Maybe we'll just keep going since we're running a little bit behind. Talking about costs, I think we covered that a bit on the municipal side. Bill, is there anything else you think worth adding there?
Just to maybe add on to what Adam mentioned about the MFPs, so they're not bought by banks, and they don't have liquidity support. So it's a means by which closed-end funds can sell to a market beyond the tax-exempt money market funds. So the tax-exempt money market funds require a puttable security back to a bank. With MFP, we don't have to pay the bank the liquidity charge, so we're able to place it more cost effectively. It comes with a risk, so you need to think about that risk and the risk that it extends out, like Adam mentioned.
Okay. And then on a taxable side, you could see more differentiations. There's got a lot more term securities. Particularly, we've seen a bit more issuance of perpetual preferred again, which is kind of similar in that respect to the auction rate securities. Usually, it goes to retail investors now, but there's no kind of built-in liquidity mechanism. They're usually traded on exchanges, so you're kind of taking the risk there of a discount, similar to what you see in closed fund common. Bill, anything worth mentioning there?
Yeah, Nuveen tends to stay toward the left part of the chart. So the majority of our $5 billion or so in taxable leverage is through either a bank, line of credit, or through margin facilities, and then we layer on some of the other forms of leverage on top of that to provide a little more flexibility. But we try to minimize the ongoing cost of the leverage and balance the risks of it.
And John, I think you'll be able to talk about the first two of the bank facilities and reverse repos, but I'll turn to this slide, and we can do it here. So we're just showing kind of the top bank providers, and BNP has been there for quite a few years at the top, really as far as I can remember. The few banks right below have also been there for some time, and then we've seen some changes, on the bottom end of the list, with banks coming in or out of the sector. But John, would you mind giving a bit of an overview there and kind of how you see costs in that sector?
I'm just happy to see the slide. I kind of like that one. That's
You provided this.
I did make the slide myself. Look, BNP has been in this space since the stall of the auction rate preferreds, and these are good loans, right? They have great large asset management counterparties. I think Adam made reference to the fact that in many situations these are good relationship loans as well, and I think the bank feels very comfortable about our coverage there. What's been really important to us over the years and has been an emphasis of my team and of our platform overall has been maintaining stability of cost for our clients, and that's difficult. We've all been through different challenges in terms of fundings and costs and regulations and what everything means. But our focus has always been, and there's a reason we've been on the top of that chart, is that we focus on stability. That stability means that we tend to be there for the long term for our clients, and that means both on the borrow from a balance sheet perspective as well as a cost maintenance. So when we talk about margin loans, we talk about asset specific recognition and looking at what they are. The greatest variance that you see is on easy to fund assets versus hard to fund assets, right? So when you look at a equity portfolio. Equities are, the most liquid of financeable assets for banks, and that, tends to certainly be the simplest to do. What we've seen over the years is that closed-end funds and everybody's need for incremental yield, you've seen a bit of a migration toward more of the high-yield collateral. You've seen more of the preferreds, and now you're starting to see, or you've seen over the last several years, a lot more loan activity in these books. Those are harder to finance assets. So it's good to see on the preceding chart that there's a band. And I know that your chart incorporated changes in LIBOR as well, so it's not as moving as one might think. But when you look at it from 1% to 4% and think about the recent rate rises, I think it's pretty consistent. We've done that through really balancing our funding sources. That's certainly been a focus, and I think that when you look at the portfolios on an asset-specific level, it allows you to provide pricing that we know we can lock in for a long term. And so that's why you see that degree of consistency there. Repo, as we talked about, is a little bit more by appointment, so that's why I think you see a little bit more of that variability. Traditionally, repo can accommodate some of the harder to finance assets a bit better than the margin loan can.
And there's quite a big range there as well because of currency. So on the low end, you'll see some euros.
Yep. So that's been, but repo is a prevailing conversation around how you can do things differently. But really, in the floating bank side, the left side of that chart, that consistency is born out of, I think, a granular review of what these assets are and a real understanding and provisioning for stable funding. Bill and others have worked with us consistently over the years in terms of things that banks need in terms of new regulations, whether it's Basel III or otherwise. Certain things that we can put into our documents and certain ways that we can structure loans allow us to be more price competitive, and I think that again lends itself to the long-term stability that's important to us and to our clients.
And you've seen that through our deals with you and other lenders, as well as Adam and other purchasers. I think we look at it as a long-term integral component of the funds, and we want to view it, even though it needs to be renewed, we look at it as a permanent source of financing for the fund. So you have good long-term relationships, and as long as the financing is competitive, you'll make the board happy that you're getting cost-effective financing, and it's pretty permanent.
And we're out of time, so I'll just flip to, we have a couple of slides in the back just listing the different forms of leverage. I'm not going to go through it, but if anybody wants a copy of the slides, just let me know. I'm happy to provide them. I think we have a couple of copies as well, but I want to take thank the panel and wish you a good remaining conference. Thank you.
Thank you, Greg, for hosting for one more year one of the top panelists of the forum. You've been a partner for over 10 years now, so thank you very much. And it's been a great conference. Thank you to the panelists.